Hello there and welcome. First of all, can I say either a good morning or good afternoon or good evening, depending on where you are around the world. And welcome and thank you for joining me tonight on tonight's episode of How I, educational series for Stratton Markets. Tonight's episode is called How I Started to Learn to Trade Using Moving Averages, written by yours truly, of course, which is obviously James Trescothick, who is the Chief Trading Educator here at Stratton Markets. Now, before we get on to an introduction of myself and tonight's agenda, obviously we're talking about CFD and online trading. And like with every sort of investment, it does indeed carry a great deal of risk. So I do suggest you do your own research and your own due diligence and be aware of the risks at hand before entering any trade. Now, with that out of the way, this slightly pot-belly, I would say, maybe winkly, certainly hairy individual is myself. Like I said, my name is James Trescothick, and I'm the Chief Trading Educator here at Stratton Markets. I have over 20 years experience in the financial service industry. I actually started off at the age of 18, where I was actually an IFA in the UK. As you can tell, I'm a Brit by my accent, so don't hold that against me. Started off as a mortgage broker, and I specialized in buy-to-let and commercial mortgages before moving into pensions and alternative investments. Then I got involved with online trading and CFD trading around about 12 to 13 years ago. I've traded myself for a prop company when I was actually based in Dubai, and I traded for the Dubai Gold and Commodity Exchange. I actually specialized in options trading. Then I ran a floor at the Philippine Stock Exchange before moving into portfolio management, and then obviously education. I'm indeed a published writer, and I've been published in several leading industry publications, including the likes of the Financial Times Advisor, CDM newspaper, FX Trader magazine, Market Watch, which is part of the Wall Street Journal, The Street, which is Jim Rogers' famous newspaper and website, as well as several other different publications. I'm also an avid market commentator. I'm very passionate, very passionate about this market, as you can tell by my enthusiasm. Actually put that down to the fact that I watched Wall Street at a very young age, probably a bit too young for really, I should have been watching it. I'm also a well-known public speaker, and I've spoken around several industry events around the world, including the likes of Dubai, Kuwait, Singapore, London, obviously Berlin, Athens, and more recently South Africa, where I actually spoke at a conference in Joburg, Cape Town, and Pretoria. Now, one thing I will say about myself as an educator, because there's lots of us outside in the market, FX educators, though I do consider myself with a very rounded experience and knowledge, not once do I ever refer to myself as an expert. Okay, I'm not ever here to give you the holy grail or the secret answer, because it doesn't exist. What I'm here is to share with you my experiences, my knowledge, my mistakes, as well as my successes, with the idea that you can take that on board and find your own way, your own path in this industry. Now, like I say, tonight's episode is called How I Started to Learn About Using Moving Averages in My Trading. So, of course, it is technical analysis based. So, first of all, we'll discuss what is technical analysis. Then we'll discuss blah, blah. Dear me, marbles in my mouth. Then we'll discuss the theory behind using technical analysis in trading, discuss a little bit about indicators, and then we'll go into what really the crunch of this episode is about. We're basically discussing moving averages. We'll discuss simple moving averages crossovers. Then we'll do an introduction to exponential, there you go, I could say it, exponential moving averages, before going on comparing the two. And then, of course, discussing other webinars coming up, and then my usual question and answer session. So, what is Let's put myself on screen so you can see me. So what is, here we go, got there in the end. There we go. Hello. Hello, everyone. Good to see you all. So what is technical analysis? Now, technical analysis is a method of trying to establish potential future direction of an asset by studying past price data and volume. Now, the theory behind obviously using technical analysis is that previous trading activity, this is the theory, so what they believe, okay, they believe that previous trading activity can give a better indication of what direction an asset may go to. It's not like fundamental analysis, where people who use fundamental analysis try and establish what the intrinsic value of an asset is. Technical analysis people, or technical analysis traders, they tend to believe that the intrinsic value is already priced in. So they look for previous patterns to give a hint of what the buying or selling activity might be on that asset in the future. Now, the basic concept was visually developed by, or developed from, the Dow theory, which was surprisingly written by a chap called Charles Dow. Now, the Dow theory believes that price movement is not random, but actually follows patterns and repeating trends. Now, obviously, we're discussing moving averages, and moving averages are a technical indicator. So what is a technical indicator, James? Well, here we go. A technical indicator, or technical indicators, shall I say, are calculations that take into account price, volume, and demand over a period of time. Now, here's some examples of some popular technical indicators. You've got the likes of the RSI, or Relative Strength Index. You have stochastics. You have the MACD. You have Bollinger Bands. You have trend lines. And, of course, you have simple moving averages and exponential moving averages. Both we will discuss tonight. Now, a simple moving average. Now, simple moving average, or as well as known as abbreviation SMA, SMA is calculated by adding up the recent closing price and then dividing it by a certain time period. I.e., for example, we have SMA 10. It takes the closing price of the last 10 days trading sessions and divide it by 10. Don't worry, you don't have to do this calculation yourself. You don't have to be a mathematical genius, because obviously all the trading platforms already work out these calculations for you. But anyway, the whole point of an SMA is people believe, or traders believe, they can use it to identify a trend and use at the same time to spot potential support and resistance levels. Now, here's an example. This is the euro dollar on a daily. Okay, remember, like I say, my rule of thumb, whenever I do these charts, I do them on the day of the webinar so they're fresh, okay? So here we go. This is our euro dollar on the daily. The theory is, if the asset is trading below the SMA, it's on a downtrend. In that case, if that's the case, it's on a downtrend, and then the SMA could potentially act as a resistance. If it's trading above the SMA, then it's on an uptrend, which also then means that the SMA could act as a support. Now, here's our little chart. Let me grab my pen. My laser pen. There we go. Brilliant. Okay, so the SMA, this is a 10 SMA. So taking the closing price of the last 10 trading sessions, dividing it by 10. The SMA is the blue line here. Okay, so remember, the asset above it, uptrend. Asset below it, downtrend. So let's have a little look-see. Okay, so there we go. We can see the asset moves above the SMA. This is on a daily, and for the next several days of trading, it does indeed go on an uptrend. Okay, as you can see, at the same time as it was above it on those couple of trading sessions, the SMA did indeed act as a support. Then we go to the next one. It comes below the SMA, and it then goes in a downtrend. Indeed, it goes in the next trading sessions as a downtrend, acting as like a minor resistance. as you can see there. It moves above it again, but this time it's not on such a clear uptrend, but it still acts as, the SMA still acts as a support for those trading sessions. Finally breaks below it again, and indeed goes on a downtrend, a nice big downtrend. And indeed, on those several occasions, it acted also at the same time as a resistance, as we can see here. Not breaking until this point, then moves above it, and indeed, for the next couple of trading sessions, does indeed move on an uptrend. Remember, this is a daily, so every candle represents a day. Then it breaks below it, breaks below it, and indeed again, of course, as it's below it, the SMA acts as a resistance till it penetrates it, breaks through again, and then becomes, of course, on an uptrend before breaking it down again, and then going on a downtrend for several other trading sessions till breaking above. And again, as you can see, it then also acts as a support on that session there. Let's look at the euro dollar, but this time, for those sort of maybe swing traders, let's look at a 30-minute chart. So here's a 30-minute chart. Euro dollar again. Remember, same rules apply. Doesn't matter on the time frame. Same rules apply. Above the moving average, uptrend, below, downtrend. Above it, potential support. Below it, potential resistance. Okay, so let's have a look again. Breaks above it, indeed goes on an uptrend. Acts as a minor support before breaking below it, then acting as a minor resistance. Breaks above it, goes on an uptrend, then again, which again, of course, acts as a support, then breaks below it, goes on a downtrend, and there you see the simple moving average for that period of time acting as a resistance as it remains on a downtrend, not breaking till this moment here, where then it goes back up on an uptrend there. Let's try a different asset. Excuse me, a little thirsty. Let's look at another asset. This is gold. Again, first, let's look on it. How about now? Can you hear me now? Can you hear me okay now, buddy? My friend, can you hear me okay now? Yay! Excellent. We got there. Okay, let me continue. Right. Apologies about that technical hiccup. But like they say, the show must go on. These things are sent to try us. So, anyway, now we're looking at gold on a 30-minute chart. Okay. So again, same rules apply. Below the SMA, downtrend. Above the SMA, uptrend. And as we can see here at the moment, it's trading a little bit above, but it's not up clear. It's really going through the middle. So it's really representing more of a ranging market. Okay, so it's not really a set direction at this stage. But then as we progress, as we see, if something really clearly breaks below it, so it is on a downtrend during this period of time. And again, as we can see then, it acts as a resistance, leading on to finally breaking above it and clearly then showing we're on an uptrend where here it acts as a support. So that's gold on a 30-minute. Now, there's another theory and another use for this. It's called the moving average crossover. Now, moving average crossover acts like this. A moving average crossover can help you identify if a trend is about to change, okay, which can enable you as a trader to potentially prepare and get ready to maybe enter the market. Now, the MA crossover works when you have a smaller SMA crosses over a larger SMA. So what does that mean, James? What does that mean? Well, like this, okay? As you see, I have two moving averages set on my screen, okay? I have a SMA 10 and I have an SMA set up 20. The 10 is the blue line and the 20 is the slightly orange yellow line. Let's call it mustard. The theory is that if the smaller, as in the 10, crosses below the larger, which is the 20, this potentially indicates the trend is changing and going in a downtrend. If it crosses above it, then it indicates the trend is changing again, but this time potentially going on an uptrend. So let's have a look on this. This is the British pound, US dollar on a daily. So the blue below the yellow, the mustard. So the 10 below the 20, downtrend. Tries to sort of pass above it, but doesn't clearly. So remains under the mustard colored line, the bigger one, remains on a downtrend. Keeps below it, remains on a downtrend, but there, this is the change we're looking for, rises above it, moving or indicating the trend is possibly changing, and indeed the asset then moves up to an uptrend. Here gives us mixed signals, so not a clear signal, because like I say with all my episodes, nothing is so always works all the time, because otherwise we all be multi-millionaires. But as you can see, clearly moves above it, giving us a false sort of signal for the time being, and it remains on a downtrend. Okay, but on this occasion and this occasion, it did indeed give us clear signals the trend was changing. Look on a 30 minutes. Remember, blue 10, mustard is 20, so blue's the small one, 20 is the larger one. Let's have a look again. Okay, so on a 30-minute chart. All right, moves above it, slide up trend for the 30 minutes. Mixed here and doesn't really give us a clear breakout, but at this point here, moves way below it, indicating a downtrend at this point around here. Indeed, the British pound moved and fell against the US dollar, so indeed it did indicate a downtrend. Now, what are the theories is, the clearer, the wider the two bands are apart, either are apart here, again is indicating how strong that possible reversal trend is. Okay, here if you can see here, it briefly tried to move above it, was quite close apart, didn't really give us a clear signal that the trend was changing, but at this point, when the bands really separated, did indeed give us a clear signal that it was on a downtrend, and that was actually quite clear for us to see there. There again, as you can see, bands are close apart, ranging market, so no clear indication that the trend is changing or moving in any set direction. Let's look at the S&P 500 on a daily. Straight away we can see it moves above, so the blue, the small, moves above the large SMA. Indeed, we see a big skyrocket of an uptrend there, not really breaking till it falls below the longer SMA, so the blue falls below the mustard, and indeed, as we saw then, it did indeed go on a downtrend. So these are things you sort of traders tend to look for. The early breakout, give them the idea that maybe it might be a good time to watch it and it might be a good time to jump into the trend, be it on an uptrend or a downtrend. Let's look at 30 minutes. So a smaller time frame again, see if it works. Okay, as we can see, blue, the smaller moves under the larger, indicating indeed a potential downtrend, and indeed the asset went on a downtrend, not changing till, of course, the blue moved above the mustard, or the smaller moved above the larger, giving us an early warning that indeed it changed its direction, is on a slight uptrend, until, of course, then moving below it again, and this time going on quite a long downtrend there. Let's do one more example. Let's look at a commodity. Let's look at an energy. This is the WTI oil on a daily. So here we go again. Moves below it, indicating downtrend, moves above it around here, indeed then indicating the trend has changed, is now going on an uptrend, and then moving around here. This is a problem here. It finally moves below it, but, and this is the thing I will say about simple moving averages, which brings me on to the next one, which is exponential. Simple moving averages, okay, is a lagging indicator. So sometimes the signals can come a little late, because clearly if we look at our chart here on the daily, WTI was actually starting to move on a downtrend there, but we didn't get the signal of the simple moving average go below the longer one till about here. So again, this is the thing about the SMA crossovers, it can be lagging. As well as that, with the SMA, it doesn't take into account breaking news or sudden developments, but that we'll discuss about exponential and why you can use that if that's more of your thing. Let's do one more example on the commodity with the SMA crossover. Let's look at 30 minutes. Here we go. Again, like I say, no really, clear pattern here. Obviously, the market is ranging slightly there. So again, it's given us not really a strong enough signal. It's really clearly more trending during this sort of period here. Till, of course, it breaks above it here, then does indeed sort of move on a small sort of uptrend before, of course, then breaking down here, and then it does indeed go on a downtrend there until moving above it again, and then going on an uptrend, and then finally breaking below it again, indicating a potential downtrend. And this is the other thing again about the SMA as well. Crossover, of course, it doesn't really give you, it gives you the heads up of a potential trend changing, but it doesn't give you the hint of how long that trend is going to be lasting for. And this moves me on to exponential. And okay, like I said, the SMA is a lagging indicator. That means it doesn't take into account dramatic movements or sudden breakouts, things like that. This is why exponential moving averages comes in, because it's another type of moving average which can obviously link to that. Now, like I say, the SMA calculates the closing price of an asset over a period of time divided by that period of time, as in 10-day closing average, closing price of 10 days divided by 10. Okay. The danger, of course, like I say, it can be affected by sudden spikes, which may add in and mix up the calculation, which is why, of course, okay, it suffers and it's known as a lagging. exponential moving average, which is different, instead actually pays more attention to what's happened more recently over the trading sessions. So what do I mean by that, James? Well, exponential moving averages, okay, is very similar to simple moving average. So as you can say, look, the simple moving average, okay, will calculate the closing price of 10 trading sessions divided by 10. Okay, and it's just all the number of the closing prices added together then divided by 10. Exponential, what it does instead, it adds obviously all the calculations, but it pays more attention to, say, the last 3 trading sessions. So if it's 10-day moving average, exponential moving average, it pays more attention, excuse me, to the closing price of day 7, day 8, day 9, and day 10. And it uses and takes more focus on those closing sessions of the recent days, with the theory that obviously that is looking at what traders have been doing, or the market's been doing more recently, than taking a look at the overall picture. Now, the difference this makes is this: it tends to be a little bit quicker with certain market movements. And I'll show you here. This is the euro dollar on a daily, okay? And this time on my chart, okay, I have the exponential moving average, a 10, and it's the mustard color, okay? And I have the simple moving average also on a 10, which is the blue color. So it's the same time period, okay? But if you notice, again, same theory, above the line, uptrend, below the line, downtrend. If you look a little bit closely, the exponential, because it takes into account more recent closing prices, or pays more attention to the closing prices of more recent activity, it seems to be a bit closer to the price of the movement. It seems to react quicker. As you can see here, the asset started to move up, but the simple didn't react as quick as the mustard color. The mustard moved quicker. Okay, so the exponential moved quicker in line with the actual current price. And you can see it clearly here. The exponential moved a lot faster in the direction of the market than the simple moving average did. And again, you can see here, the simple moving average remained pretty close to the candle line. It's lagging. The exponential reacted a lot quicker when the market started to change its direction, because, like I say, it's moving closer to the price of previous sessions. And you can see here, the simple moving average, okay, remained in line, not really heading up an uptrend, but the exponential moved a lot quicker and gave it a heads up, indeed, that the trend was changing a lot quicker than the simple moving average did. And as you can see here, at the same time, it moved a lot more in line with the asset, and it started to move downwards because it was taking account what's happened more recently, was the simple moving average was lagging a little bit behind on where the trend was going. Let's look at the US dollar Japanese yen. This is on a 30 minutes. Okay, SMA 10, EMA 10. EMA is mustard, SMA is blue. Okay, let's see it again. Right, the simple moving average is there, the same time frame, it's 10 periods again. Okay, we're not doing anything different with the time periods. The SMA moved up quicker and higher, more in line where the asset was going than the SMA did. And as we can see here, and this is the other thing, okay, and this is a negative thing of exponential moving average, right? The SMA remained right about here, still indicating a downtrend. The exponential, because it's closely linked to previous prices of closing sessions, reacted a lot quicker because of this breakout. And this is a fake breakout, because it broke up, and the EMA started to move up higher. It's a fake breakout, but it wasn't a change in direction. It remained going on a downtrend where the SMA didn't react, whereas the EMA did. Because it's closely linked to the price and to the previous prices, it's weighted down, it makes more focus. It is victim to the breakout. And you can see this clearly here. It reacted on a fake breakout where the SMA went, no, I'm not convinced. It's a fake breakout. It's still going on a downtrend. And the SMA gave us a clear indication that, okay, no, not convinced that the trend is changing. And as you can see here, again, he reacted a lot quicker than the SMA did more in line with price, and indeed indicated a downtrend there. Again, SMA here, okay, moved up further, but again, it's victim to a fake breakout, whereas the SMA, the normal one, simple moving average, didn't react to it. So which is better, the simple moving average or the exponential moving average? And again, it really depends on your sort of style of trading. Let's look at and compare the two. The SMA and the EMA. First of all, the plus side. SMA can give a smooth indication of direction, and it cancels fake breakouts because it doesn't focus on more recent trading sessions. It takes the average of the last 10 trading sessions or 20 trading sessions, depending on where you set your SMA parameters at. Negative side of an SMA, it's slower, which could cause a lag in potential sell and buy signals because it's taking the overall view is a bit slower. So when the trend is really changing dramatically, you might be left a little bit behind, okay? Whereas the EMA, the plus side, is faster and calculates more recent price movements. So if the trend is generally changing, it could indeed give you more of a heads up or early warning to potentially jump on in. Negative, because of this though, it can fall foul to fake outs and give incorrect signals when, whereas the SMA might be able to give you a smoother, clearer picture. So those are the plus sides and the negative sides of both the SMA and the EMA. Now, up and coming into events, other things we got lined up. 30th of October, we've got the next episode of How I, and this one's called How I Got to Know About Price Action and Naked Trading. No, I'm not talking about trading naked in front of your laptop or indeed in front of your mobile or tablet. But then again, whatever you do in your private life is your business. I'm really talking about stripping down the basics and looking at charts with very, very few indicators and really trying to look at price action and try and establish where the buyers and sellers actually are. That's on the 30th of October. And don't forget the November webinar schedule will be released at the end of this week. Some really exciting stuff for next month, which I hope you guys will, and ladies, of course, will find insightful and enjoyable. If you wish to speak to me, you please feel free to email me at james@strattonmarkets.com, or indeed, you can follow me at Twitter or direct message me on my Twitter account, which is @jtrusgothic. And indeed, you can join a very unique, exclusive following of 49 followers. But anyway, come along and join me by all means. I do share certain things on there in relation to the market, things like that. Now, I'll just take myself off for a second. Before I go into the question and answers, don't forget, of course, we have indeed been talking about online and CFD trading. And like with every investment, it does indeed carry a great deal of risk. Do suggest you do your own research and your own due diligence and know the risks involved before entering any trade. With that out the way, I'll quickly put myself back on. Hang on, here we go. There I am. Yay, hello. Right, before I go on, is there any questions anybody like to ask me in relation to tonight's episode or anything in particular people would like to ask me? Anything at all? Did everybody at least find it interesting and insightful? Did you find it useful? Or is everybody sick of my voice by now? Ajesh, did you enjoy it? Yes. So you find it useful, yes? Good. Good. Do you think it will be of some help for future trading? Yes. Okay, good. Is there, like I said, I ask this every week, because don't forget, ladies and gents, okay, I write this material, I put this stuff together, and it's really is for your education and for your help. Okay. So, if there's any subjects or areas you like me to cover and write in the future, then please feel free to ask me. Okay. And I will do my best to write something. I mean, for a prime example, next month, somebody requested a webinar to focus on WTI oil. Okay. That's a good question. I'll get to that question in a minute. Did that question to, like I say, to do a study on WTI oil and Brent. And I've gone away and I've written a case study on things to be aware of and look at when you're trading WTI oil and Brent. Okay, so yes, if there's any topics or subjects people like to, like me to do, then please do. But I've got a great question, Rajesh. That's a great question. Can we use a 50 moving average along with a 10 and 20? Yes, you can. It's called actually a moving average with ribbon. Okay, and the theory still it still lies with the same theory. If the 10 and 20 moves above the 50, indicates a change in direction. But the idea, of course, is that if the 10 correlates with the 20 moving above the 20, then it's a clearer signal that the trend is changing. But that's the theory. But yes, you can indeed moving a 50 moving average along with a 10 and 20. But yes, I mean, like the thing is, like I say, I mean, again, you've got the 100 moving average as well, which a lot of people use, especially when it comes to maybe, position trading, when they want to hold their position in the market a little bit longer. People look at 100 and use the 50. But that's a very good question, Rajesh. Very good. Very good. Thank you for asking me the question. I like the interaction because it gets quite lonely otherwise. It's just me talking. And though I do like the sound of my own voice, I must admit, even I get sick of myself sometimes. I don't really. Is there any other questions at all? Anything else I can help you with? No? But okay, did everybody enjoy it? Everything like that? Oh, Rajesh, no, thank you for your time. Thank you for joining me tonight. I really appreciate it. And thank you for your question and your interaction tonight. I appreciate it. But no, thank you for your time. And I hope you enjoyed it. And I hope to see you next week. Don't forget, guys, email if you sort of have a question later you forgot to ask or you want to talk to me directly. Here's obviously my email address. Here's my card. Here's my email address and my Twitter account. So please feel free to email me or contact me on Twitter if you have any comments. At the end of this webinar, of course, there is also a rating. So please rate it. Be honest with yourself. So, if you enjoyed it, which I have no doubt, give me 5. If you sort of liked it, give me 4, but whatever. But anyway, till next time, can I wish everybody a fantastic day. Special shout out to Rajesh. Rajesh, thank you so much for your questions. Brilliant. I love it. That's fantastic. Look forward to seeing you next week. At the same time, look forward to seeing every single one of you very, very soon. And can I just say, end off by saying either a very good morning or a very good afternoon or a very good evening or even a very good night, depending on where you are around the world. Till next time, every single one of you, trade safe.